This video is brought to you by togetherbudget.com. When it comes to investing, one of the key concepts is understanding risk versus reward. This is especially important for beginners who are new to the world of finance.
That's right. So, let's start with the basics. What are some types of investments that we should be aware of? I see. So, stocks can be quite volatile. What's the difference between a growth stock and a value stock?
Growth stocks are those that have high potential for long-term growth, often in emerging industries or companies with innovative products.
And what about value stocks?
Value stocks, on the other hand, are undervalued compared to their intrinsic worth. They may not have as high a growth potential but offer lower risk and potentially higher returns over time. Now, let's talk about bonds. What are some key differences between government and corporate bonds?
I think I understand the basics of bonds, but can you elaborate on the types?
Government bonds, also known as treasury bonds, offer relatively lower risk since they're backed by the government's credit. Let's start with the basics. When it comes to investing in stocks, you have two main options: individual stocks and index funds.
Individual stocks sound like they're more personal, but what exactly do we mean by that?
Exactly. Individual stocks refer to shares of a specific company. When you buy an individual stock, you're essentially buying a tiny piece of that company.
So it's like owning a slice of Apple or Google?
That's right. But keep in mind, the value of your investment can fluctuate wildly based on market conditions and the company's performance.
Okay, got it. And what about index funds?
Index funds are a type of investment that tracks the performance of a specific market index, like the S&P 500.
That sounds more straightforward. What do I get with an index fund?
You get a diversified portfolio of stocks that mirrors the overall market performance. It's like having a snapshot of the entire stock market in one investment. Now, it's essential to understand that both options have their place in a diversified investment portfolio.
That makes sense. But if I'm just starting out, which one should I choose?
For beginners, index funds are often the safer bet due to their lower risk and more stable performance. So, let's dive into the world of bonds. A bond is essentially a loan that you make to an entity, whether it's a corporation or a government.
That makes sense. And when we invest in bonds, what exactly are we getting in return?
The interest payments are usually made periodically, such as semi-annually or annually. This provides a regular income stream for investors.
I see. And what about the credit rating of these bonds? How does that impact their value?
Think of credit rating like a report card for an entity's ability to pay back its debts. Investors use this information to assess the risk of lending to that entity.
That makes sense. And what about the different types of bonds? Are there any notable ones that beginners should know about?
When it comes to diversification, ETFs offer a unique advantage. They allow you to invest in a variety of assets with just one investment.
That's right. But what does that really mean? Can you give us an example?
Let's say you want to invest in technology, but don't have a large sum of money. With an ETF, you can buy a small portion of the S&P 500 Tech Index.
That makes sense. But what about the potential for losses? How does that work?
One of the key benefits of ETFs is that they're transparent. You can see exactly what you own and how it's performing at any given time.
That transparency is a huge selling point for many investors. Can you tell us more about the different types of ETFs available?
So, let's dive into the world of investment strategies for beginners. One of the most crucial concepts is diversification.
Diversification? That sounds like a fancy word for spreading out your money. Is that right?
Exactly. By diversifying your investments, you're reducing risk and increasing potential returns.
That makes sense. But how do I actually go about doing this? Should I invest in individual stocks or ETFs?
Now that we've covered diversification, let's talk about another important concept: dollar cost averaging.
Dollar cost averaging? I think I've heard of this before. Can you explain it in simple terms?
This tutorial is brought to you by Malik Abwalzait.